Hi guys. So in this video, we'll talk about usage of ARIMA models to predict stock prices. Now you have seen like countless videos on stock prices prediction. Maybe a lot of them are on ARIMA models. Now there could be more on other models like LSTM and stuff. So we would talk about them in next videos. So I'll make like a series of videos on various models. So ARIMA is like very versatile model used for a lot of time series data. And what we are going to do is to start off this mini series stock market prediction using ARIMA model. Now this is like a common thing among quantitative analysts that predicting stock prices is just not feasible. So it's just too random, and you should rather rely on robust models like uh, maybe fixed income securities, bonds and stuff. The stock market, so this is like too much volatile. So with that aside, I have seen myself a lot of videos on ARIMA model to predict stock prices, and people are claiming that they have made money. So I don't believe it, and in this video I will show you that why I do not believe in that you can make any money out of stock market. Maybe you can get lucky, but what I'm going to show you is that it's just not possible. So let's begin. So this is the library Yahoo Finance, and we are going to use that to load our stock data. We are going to use Google stock prices for last 5 years with granularity of 1 day. Now there are two columns, close and adjusted close, so at which the market closed for that stock. I want to set the frequency of daily, which means I'm going to have some NANs because the market is closed on the weekends. So what I will do is I will just do a fill NA, and it just picks up the value that was before that, which was on the Friday. So we take the same value for Saturday and Sunday as well. So it's not going to, so it could create problem. I mean, you could argue that let's say there was spike on Friday. Now the autoregressive part is so there are various autoregressive components because ARIMA is about lag time series. So one is regressed upon the other, and because you have like such a big thing going on Friday and you are just filling that value with that, so it could mess up the regression. But then you could also argue that it's going to be averaged out, and ARIMA model is just so what we have seen before it on the terrorist data set in the time series forecasting videos. So we didn't quite catch the outlier, so we were looking at averages. So that means we should be good even by doing this filling. So let's filter the column. We are only interested in the close. I could use adjusted closed as well, but I think I'm fine with close. So let's plot it. So this is our original data set of last 5 years. Google, which is Alphabet now, so that's called Alphabet. But everyone says Google, so I will just stick to that. Let's do a decomposition on that. I want to do additive. I could do multiplicative as well because there could be exponential stuff going on there, but you could play around with that. Now let's extract these trend seasonality, and this is our plot. So original data is there, trend and seasonality. So there is definitely seasonality there, and then residuals. So what we have learned in time series is that there could be some signals in the original data, and that has just crept into the residuals. So that's why the trend is So more or less, by looking at this plot, trend looks very much like original, so it doesn't look like any signal has been lost to residuals. So we'll see. Now let's do a Dickey-Fuller test, which would tell us that the data is stationary or not. So it is not stationary, so it should be less than 0.05 significance test. So we'll load this utility, and then we are going to lag this time series, and it tells us that we have to lag once. So let's do that. We are doing difference between the values, and then for that we have to do a drop NA, and then this is our p-value, which is very much less than 0.05. It's close to 0, so we are fine. So this is the order D that we need, and now we need to find P and Q. So for so we have this autocorrelation plot and then partial autocorrelation plot. So autocorrelation is the moving average part, and then partial autocorrelation is the autoregressive part. So we can see that on the first hit itself. So we are actually crossing this shaded region. Now we could use this 1. So this is the first time we are crossing that shaded region. 2, 3, maybe we could use 5 as well. We could use 13 as well. So all that's fine. But we are not going to do that manually. Now this is the PACF plot. We are going to use some library. Let's do a train test split, and then this is the same graph, except that I have colored the training part. So this is test data. Let me correct that quickly. Train data. Excellent. So this is the test data and then train data. Now we do the loading of PD ARIMA. It's usually there, but if it's not there, uncomment and run this. So that would actually tell us the ARIMA order that we want to pick up. So I want to run this on the training set only, and this is the ARIMA order it's giving. So autoregressive is 0, and then difference is 1 that we have found above as well manually, and then moving average is 1, of course. So what we found here is the moving average is 1 actually. So partial autocorrelation function, fine. So which means we are going to pick up that ARIMA order, and then we are going to train on the training data set. Now we'll look at our residuals. So they are all centered around the mean, which is fine, and this is the normal distribution, so that is again centered around the mean. So we have fine, now we have built a very good model. We could even calculate the RMS value, but this is fine as far as residuals go, so that the signal has crept into the residuals, and that we could tell from the trend seasonality, residual decomposition as well, the remainder. So let's do a forecast, and here is the problem. So we just get a flat line there. This is the forecasted data, and if with that what it's doing is just taking the average of it. And I have actually printed this value before, and it was more or less the same value as if it was just taking the average. And if I just plot the forecast and the test data set, so we get this flat line. So obviously it's not capturing the pattern. So this is the thing with stock market, it's just too volatile. You can't make a prediction of it. So ARIMA is out of the window. So I don't think I will even try the exponential smoothing part. That would suck even more. So we will just use some advanced forecasting method in the next video rather. I will look at the profit model, and then we will go into deep learning. So deep learning looks promising. Let's see what's there. So I will see you in the next video, and like always, if you like this video, put a thumbs up, please subscribe. I'll share this notebook in the description. Have a good day. Bye.